We're in Houston along with hundreds of risk and insurance professionals for the 2015 IRMI Energy Risk and Insurance Conference. The oil and gas industry is subject to many outside influences, from commodity pricing and regulation to domestic legislation and international trade deals. All these factors affect energy risk. We begin our team coverage with Richard Blades. He is chairman of Wortham, the largest independent insurance broker based in Texas. Here's what he had to say about today's energy risk.
There are a number of factors impacting the oil and gas business today, but of course the obvious one is the dramatic drop in crude oil pricing over the last 7 months. Going down to what was the low 40s earlier today is having a significant impact. In some ways it's actually improving the risk for the energy risk because we were at on a frantic pace when crude oil was at $100 a barrel. Now that it's down lower, you've got companies that are doing layoffs, and the service companies are keeping their more experienced crews and engineers, which is improving their risk profile. When crude oil was at $100 a barrel, people were going too fast, especially in the shale plays. So you had a lot of auto losses, a lot of workers' comp claims. You had sleep-deprived workers who had been out in the field for a couple of weeks driving to the next job or maybe driving to get home after an extended time out in the field. And so hopefully as the pace slows down a little bit, we're going to see a reduction in those autos and workers' comp claims. So I think one thing to look at is not only the reduction in payroll and autos that you may have with reduced activity, with the rigs being laid down, the service companies laying people off, you've got less activity, but your claim activity should go down. So one thing to evaluate is your collateral requirements and your loss pick on your primary casualty. I also think with the more experienced crews, you're going to have fewer control of well events. Interesting with the lower commodity price, some of the mature fields offshore, you may want to reevaluate how you're insuring your offshore platforms. Some of those platforms you may not want to replace with the same structure in the event of a total loss. You may want to go back with a smaller structure or not at all. So perhaps you insure that for a lower agreed value or removal debris wreck only. The lower commodity price, though, will create more mergers and acquisitions in our space or in the energy space. That is going to create an uptick in D&O claims, or at least on the defense cost side. So we will see some pressure on D&O pricings on the primary layer, but that will be more than offset by the soft excess D&O market. You should absolutely reevaluate your retentions because some of the insureds, depending on what specific segment of the industry you're in, they may be having cash flow constraints, and so perhaps their historical retention level is too high today. You need to go back and reevaluate and make sure you can still handle that type of retention level. The materiality level of a retention level when crude oil price was $100 may be totally different today. There are a number of emerging risks for the energy industry, and of course drones are becoming more and more popular in use, and you need to address that, either modifying some of the existing coverages or adding it to an aviation policy, and specifically address the drones, get the information, communicate to the underwriters. Cyber, of course, is the biggest emerging issue. I think we're all aware cyber is in the news all the time, and every firm, including energy firms, have exposure to traditional cyber exposure. If you've got personal identifiable information or confidential client information in your system, you've got exposure. And there are over 50 companies that provide that traditional cyber coverage to reimburse you for the data breach, the privacy litigation, credit monitoring, and the notification. But probably what's more important for the smaller and mid-sized energy firms is going to be the services they provide, the risk mitigation and also the crisis management. Now, the larger energy firms, with their sophisticated networks and staff, they don't necessarily need that traditional cyber coverage. Probably also they can retain that within their self-insured retention with their financials. And so what's more important than the larger energy risk is going to be the critical infrastructure and the resulting damage. Recently there was a cyber attack on a German steel mill which caused significant damage. And so just think what happens if there's a cyber attack on a SCADA system or on the industrial control system, and that causes significant property damage, bodily injury, failure to supply, third-party property damage. And so the larger energy companies are endeavoring to get the cyber resulting coverage in their core property and casualty programs. They want to review your traditional policies and try to get the cyber exclusions, if you have a CL 380 or something similar, out of those policies to give you the resulting coverage. One of the issues that's a challenge, though, is the cyber terrorism. The standalone terrorism markets don't want to delete the cyber exclusions simply because the potential aggregate exposure. They're concerned if there's one concentrated attack, a terrorist attack, that it could hit multiple insureds and they simply can't model that exposure. Cyber product market is still evolving. There's some unique products coming out. In Lloyd, certainly there's several products. The Brit Syndicate and Consortium has up to $350 million capacity for some of the cyber resulting coverage there. Aegis has got a facility out, and Consortium behind them. I believe that's up to $50 million. AIG, of course, also has a difference in conditions product. And there's some other players out there, most of them in London, that will help provide coverage if you want certainty. There is a bit of a slow take-up on some of these products because some people are concerned about the assessment process, the cost of a standalone product, a new product they perhaps hadn't budgeted, and just, the overall limit may not be material to some of the larger companies that are buying a big and property limit. And so I do think this is going to continue to evolve over time. Matter of fact, there's some recent improvements, some of the wordings that came out recently. And as it evolves, I think you'll see that take-up improve. But interested to see where we are a year from now. The role of your broker is to help you identify and then transfer your risk. And I think it's important. Sometimes that's going to be buying insurance, or perhaps it's looking at an alternative way of transferring that risk, looking at your contractual liability and support with your legal department. The role of the broker isn't just about buying insurance and negotiating rate reductions in what is today a very soft market for most lines of coverages. When I've had clients have major claims, policy limits loss, they don't really talk about the modest savings or incremental savings they received at the last renewal. What they want to talk about is the coverage. Do they have the right endorsements? Is the wording there? And do they have the right underwriters on the program who are responding to their claim in an appropriate manner? So I think it's important in this market for a broker to negotiate the right cost. We're all looking at cost, especially in today's commodity environment, but also make sure that you expand the breadth of the coverage or the sublimits and try and negotiate the deal with incumbent underwriters where you've had a long-term relationship to the benefit of your client.
Over the next few days, we'll bring you more insights from industry leaders focused on risks and solutions in the oil and gas business. So keep it here for complete coverage of the IRMI Energy Conference, right here on RIN TV.